Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review, this time for the week ending October 11th, 2024. So an eventful week overall in the markets. First it started on Tuesday with the failed announcement by Chinese authorities about the fiscal stimulus. So the market's hype pretty much deflated for the rest of the week. So there was no new measures that were announced following the week-long holiday. But now there's something that has been added in the calendar. Tonight, well, our time here, Friday night, but in China it's going to be on Saturday morning. They will be announcing, discussing fiscal policy and announcing new measures. So markets are expecting 2 trillion yuan of new measures, so about 283 billion US dollars. So sizable, but still. It's not yet the big bazooka that they're taking out, and they should be focusing more on local government debt and boosting consumption. So two things that are interesting when you're in a balance sheet recession environment like they are in China. Discussed that a lot in the last few weeks. Monetary policy becomes inefficient and fiscal stimulus becomes the only way forward. So it seems that they're doing the right thing, but will they be doing it? Will they be doing enough? Quickly enough, we'll see. This could be make or break for the markets next week. Also this week, the economic data was not too many signals, but the race for the US election is taking a turn towards higher odds of a Donald Trump win. We'll be discussing that in a minute, but and it's going to be showing you how tricky it is to call the US election, especially this one. So maybe let's focus on this week's markets at the close on a Thursday. Interest rates higher as markets are reacting to the swing towards higher odds of a Trump win, mostly because if it's a Trump win, you should expect more fiscal stimulus, more solid growth, but also more inflationary pressures, lower interest rates from the central bank. So all of this, of course, pushes longer rates higher. The 10-year rate in the US went back above 4% this week. So in Canada, markets are integrated, so you're getting the impact here also. For stocks, it was actually a pretty good week. Now we're at close to 19% year to date for the TSX. In Canadian dollars, 27% for US stocks. A tougher week for emerging markets as the bubble deflated in China. We'll see if what we have announced this weekend pushes the market up again. But so far this week, it was a bit of a letdown. Oil prices higher, gold prices a little bit lower on the week. So maybe looking at economic data here in Canada, we had the jobs report. It's always a tricky one to comment because it's just so volatile. We had a strong beat. Expectations were around 25,000, and we got 46,000-ish here. When you look at the picture, you don't see much here that changes, that should change the mind of the Bank of Canada. The unemployment rate that you see on the right, ticked down a little bit lower at 6.5%, but the trend remains higher. So the question is, where should rates be now? Does that report change anything? Not so much. Rates should be close to neutral, so the door is fully open for them to cut by 50 basis points on October 23rd. The market is pricing that possibility, so the door is open. There's going to be the business outlook survey that's going to be released this morning. As I'm recording this, it's prior to market open. This report will be released at 10:30. Likely this one is going to be more telling for the Bank of Canada on how to conduct monetary policy looking forward. But this job report here, I would say, positive news, but maybe not enough to change the mind of the Bank of Canada. Looking at the US now, disinflation continues on the headline, but caution on the short-term trend. So if you look at the chart on the left, you see that the pace of inflation continues to fall, whether it's the total core. There was a small reacceleration for super core, which tends to be sticky these days, but overall the trend is a bit lower. If you look at the 3-month pace, the chart on the right, you're seeing a small rise in the short run, but the Fed looks at core PCE and this is CPI. So two different studies here, two different reports, and the elements that supported an acceleration of growth in prices in this report do not impact the core PCE report. So we're in the technical weeds here, but the favored measure by the Fed should not be impacted by the elements that are pushing this higher here. So still you need to be careful, you need to be cautious, but we still believe that the path of least resistance is multiple cuts as the Fed also tries to get towards neutral somewhere in late 2025. So central bank update here, you have the Fed on the top left. What we're seeing is that markets are pricing in about 87% odds of a 25 basis points cut on November 7th. And after that, it's a 25 basis points cut per meeting for every meeting until May, which is the farthest data that we have. Bank of Canada on the bottom right, interestingly, as it shows here, markets are pricing 57% odds of a 50 basis point cut and 43% odds of a 25 basis point cut. So the door is open, and after that, markets are pricing 25 basis point cuts at every meeting until the data that we have here, which ends in March of 2025. So nothing changed this week. We still think it's a synchronized cutting cycle. We were having more central banks cutting. We had New Zealand cutting 50 basis points. We had South Korea cutting by 25 basis points. So the synchronized cutting cycle it should continue, and this should be supportive of economic growth and market returns in 2025. Now looking at the presidential election here, just want to take some time. So you have two charts on the screen here. On the left, you have the spread in the polls for for 6 of the identified battleground states. And if you look on the chart on the left, you have a lead by Mr. Trump. So if it's positive, that means that that Trump leads. A lead by Mr. Trump in Arizona and Georgia, but he's had those leads for a good while. But what has changed recently is that Pennsylvania is slowly swinging his way, but Michigan, which is the kind of green line, is swinging quickly towards Donald Trump. So what's going on here is that every single state has a different narrative, and they have different the electors have different focuses. And I was reading about the Michigan situation, and remember that there was a state referendum in 2022 on abortion rights, which passed easily, and now it's written in the state constitution of Michigan that you have the right to abortion. So whatever happens at the federal level will not change that. So what you're reading is that the electors in Michigan, they're tired of hearing about this national wedge issue of abortion because it doesn't impact them. The message doesn't resonate with them. And well, if you take this issue away and they dig in Kamala Harris's platform, they don't find much there to convince them, at least on the economic side, to vote for her. So the momentum is swinging back towards Mr. Trump. So just to show you how tough this election is to call and how fragile the results will be. It will hang on a few of these kind of wedge issues at the local level here. But what we need to understand, the chart on the right, is that the odds of a red sweep are rising, and the markets are starting to react to that. So the momentum is shifting towards Mr. Trump in the last stretch here. So we need to take that into consideration. Who has the momentum at the time of the election usually is favored. So we need to take notice of that, and markets surely are for now. So this is the update. The next few weeks will be interesting for sure. So what we'll be watching next week, in Canada, we have CPI inflation next week. We should dip below the 2% target for the first time since I think 2021, if I'm not mistaken. Existing home sales, housing starts, and in the US, retail sales and a bunch of housing reports, and AHB, housing market index, housing starts and building permits. And also, it's not here, but in Europe, the ECB is set to, as expected at least, to cut by 25 basis points, just adding to this cutting cycle trend. So that wraps it up for the week. Hoping that you appreciate the comment. If you do, please share, and of course, come back again next week.